Meanwhile, European markets have opened up for trade on a positive note, shadowing what we've seen across Asian markets this afternoon. 1% up on the Spanish market, IBEX 35. The French market, CAC 40 is up as well by a similar percentage. And the FTSE 100 in the UK is also looking smart this afternoon after the US Federal Reserve decided to modestly trim its stimulus program. But then, of course, Asian markets, European markets, they are rallying on the back of the fact that the Fed has really essentially taken the sting out of the tapering by recommitting to keep interest rates rather low for the majority of 2014, thereby leaving Wall Street at record highs and the dollar also galloping. But I guess what's interesting is that when you look at this knee-jerk reaction on equities, on the dollar and on treasuries, is that while the Fed has indicated in its commentary that it now believes that there is going to be higher US spending growth. On the other hand, when you look at the forecasts or the revisions that have come in, in terms of the forecast for 2014, they've gone the other direction. In fact, the Fed has cut the central tendency for real growth and inflation in 2014. So one wonders if this knee-jerk reaction in equities and the dollar, it's likely to peter away rather quickly. Joining in for a quick chat and for some more perspective at this point in time, all the way from London, an expert voice, Ishaq Siddiqui, market strategist with ETX Capital. Ishaq, thank you very much for joining in, and always a pleasure talking to you. Majority of the observers obviously were talking about whether or not we are going to see a tapering coming in this time, but obviously the odds were increasing in the last 1 week that we might see a mini taper coming along, which did. But I guess the surprise is the fact that the forward guidance is not really that dovish. How can the start of taper be risk-on?
Yeah, absolutely, and I think that's the one thing that a lot of investors have been looking at, the fact that the forward guidance may be undermined at some point. I think the Fed is taking more of a prudent stance going into 2014. Generally, the way that you've even described it is that they've given this kind of silver lining by saying that they're going to keep interest rates low for an extended period, which is a positive in the face of any tapering. But I think at the moment, Mr. Bernanke, as he's on his way out, would rather keep a dovish but prudent approach. And when Mrs. Yellen takes over, it's likely that the Fed will have to change their forward guidance. We know, through the course of 2013, we know that forward guidance is a changeable policy. We've seen that with the ECB and certainly with the Bank of England, who have to currently adjust their own forward guidance measures. So I think investors need to take it with a pinch of salt that I shouldn't read too deeply into the fact that the Fed will, at some point, have to adjust. And again, it's all dependent on economic data. It's unlikely that the Fed will U-turn on their move today. It seems like the Fed is in autopilot, and they will continue the reduction of asset purchases. And I expect a wider reduction by the time the unemployment rate drops to 6.5%.
So therefore, are you looking at 2014 as a year when global liquidity tightens? Or are you expecting that liquidity is perhaps going to continue to expand, perhaps at a slower pace, because you've got another key central bank, the Bank of Japan, continuing to, in fact, accelerating its stimulus program. So can one assume that globally there might not be a major difference in the amount of liquidity availability?
Yeah, certainly, especially for the emerging market space. I think as long as the Fed keeps the interest rates low for an extended period, and at the same time we have the Bank of Japan providing liquidity, and also other central banks such as the ECB, who at some point may look at another LTR operation. It obviously suggests that with the Fed stepping out of the stimulus game, we still have enough support in the market. And I think emerging markets have taken the Fed's action in their stride today. It seems to be much more of a positive reaction than a lot of people expect, and I think that's mostly for the reason that a lot of the emerging market space is better prepared for the flight out of capital that was previously held back in May 2013 when the Fed announced their intentions to taper. I think the interesting one is the India's reaction with the Sensex down on the back of the move, and I think that's generally more due to the domestic economy and the fact that the RBI needs to do a bit more to stimulate the Indian economy.
Ishaq, what did you make of Fed's guidance that it will maintain current target rate for Fed funds rate well past the time that the unemployment rate declines below 6.5%? The earlier stance was around these levels, we might see some tinkering as far as the Fed fund rate is concerned, but that has been shot down. It now is very clear that even if a QE taper were to conclude around October, November next year, that's the assumption going the right now, we might actually see the US persisting with a near zero interest rate environment for perhaps a very long time. Do you think that's the correct argument here?
Yes, I think so. I mean, I think that the zero interest rate argument is something that a lot of people need to put into consideration, that is most likely to be the picture that the Federal Reserve is painting for the next 2 to 3 years. It's one that does pose some risks, particularly when it comes to inflation, the inflation risk in the U.S. And we know that the U.S. is currently dealing with low inflation. I think in general that could also have an effect on the wider economy. So the zero interest rate policy, in the way that I see it, is I'm a bit ambivalent and mixed to the old view that I think that on a short-term level, at least for a year or two, it could be positive. But if it goes beyond 2015 or 2016, and we see the Fed not hiking interest rates, but beyond 2016, I think that can pose a threat to the U.S. economy. But I don't think they'll do that. I think the Fed has been relatively clever in the way that they've engineered their exit strategy of QE, and I think they'll be just as clever when it comes to hiking interest rates too.
Ishaq, brief last word. Given the fact that the Fed is so data dependent, if we do continue to see stronger data coming in from the US, then there's no risk of a policy reversal, right?
No, I don't think it's going to have to be extremely drastic if we're going to see a policy reversal. I mean, of course, the Fed has said it's data dependent, which they'll have to stand by. But, we'd have to see a massive deterioration in the U.S. economy before the Fed starts really looking to provide more stimulus going back, start buying, amping it back up to $85 billion. I think we'd have to most likely see a drop-off on U.S. growth right now. I mean, we're looking at 3.5% for 2014. I think if it slips anywhere around 2.5%, then we can see that in consideration. But I don't see it dropping by 1% in 2014 in any way. And our forecasts are for 2014 for US GDP to be around about 3.7 to 4%.
All right, Ishaq. Yeah, good to have those points. Thanks very much for your time, as always. Pleasure talking to you. Let's take a short commercial break right now, but we're going to be back in just a couple of moments to talk to the management of Mindtree, so don't go away.